2019. Question number 1 on company final accounts. So here we have Sanuga PLC, 31st March 2019. There is a trial balance. And additional information. There are 10 additional information. First one is about director's fee, which is under administration expenses. Then we have a verdict of case, right? The final verdict of a court case was declared, and we have paid on 10th of May 2019. So is an event after the reporting period. Number 3 is about the warranty. So we have to make a warranty provision. Number 4 is on the lease agreement. So we need to find out how much is the lease interest and the lease creditors, current liability and non-current liability lease agreement. In the PPE depreciation, and there is a revaluation as well. The depreciation we need to calculate, and also there are purchases, acquisition during the year, land and an office equipment. And there is a revaluation, building revaluation, income tax, and finally there is an interim dividend and proposed final dividend. Required profit and loss and other comprehensive income, changes in equity, and the financial position, statement of financial position. So let's draw the format for these three workings. Right. So here we have, I have recorded, I have filled the format. Working for expenses analysis and statement of PPE, and the profit and loss, statement of financial position, and changes in equity. Draw the format. I'll give 2 more minutes. So this is a very important question because definitely in your paper also there will be a similar type of question with similar type of adjustments. So we need to focus on these set of adjustments, right? Definitely 80% of these adjustments will be checked, and there may be 1 or 2 new adjustments on it, right? So it's better to focus on this type of question. Okay, So let's start. If anyone need more time or if there is any doubts or if you want to clarify anything, please let me know. Okay. So let me start with additional information. So always your first step is to draw the format. First we draw the format. Then we start with additional information. Right. So additional information number 1. The director fee of 900 is included in the administration expense. The audit fee for the year ending 31st March 2019 were 250,000 and it had neither been paid nor accounted for at the year end. Right, so this is about the administration expense. If you check the trial balance, you can see there is an administration expense of 4,500. So let me take this administration expense as the balance brought forward, 4,500. Right. So we think this is the administration expense account. Right. So this includes, right, I will take it separately. So this includes 900 director fee. So we have to separately show that director fee. So if you take 900 as director fee, the administration fee will be 4,500 minus 900. That is 3,600. Because as a note, if we pay, directors or if we pay for accounts, auditing, taxation and all, that has to be shown as a separate note. Profit before tax note. Right. So total 4,500 we can show separately in the administration column. Right. So that is first part. Then they say that the audit fee for the year ending 31st March 2019 were 250 and it had neither paid nor accounted for at the end of the year. So audit fee is payable. Double entry is debit the administration expense account 250 and it is a current liability. You can credit accrued audit fee. We debit the administration expense and we can credit other payables. Right? Accrued audit fee. 250. Accrued audit fee will be added to the admin and it is payable, so current liability. Right. So that is the first adjustment. That is the first adjustment. Then the second adjustment is the verdict of case filed by a customer against the company was declared on 10th of May. Accordingly, a claim of 600,000 was paid to the customer on this day. So 10th of May, that is after the financial year end, we have paid 600,000 as the claim. This case has been filed on 1st of January. So this is a, even though this is the events after the reporting period, this is an adjusting event. The final result was given before the financial statement authorization. However, the company had not recognized any provision on 31st March. Financial statement was authorized for issue 30th May. So final verdict or final decision was given 10th of May, authorized 30th May. So this is called an adjusting event. So we have to make a provision of 600,000 for this claim. Right? We have to make 600,000. Provision for claims. Provision for claims. And this is other expense. Provision for claims. 600,000 other expense. Right, so I'll explain again. Now this is a transaction which occurred after the financial year end. And these are called events after the reporting period. Events after the reporting period is LKS 10. Right, so according to the LKS 10, there are adjusting events and non-adjusting events. Right? So adjusting events are like bad debt, stock. We are selling the stock lower than the cost. NRV is less. Right? A court case, final decision was given. So likewise, these are adjusting. So for the claim here, we need to make a provision. Double entry for the provision is expense account debit, provision payable account credit. Expense account debit, payable account credit. This is the double entry for the provision. Okay. Then moving to the third adjustment. Third adjustment is the company sells products with 1 year warranty period, and the warranty expenses paid during the current year for sales done during last year was 470,000. This is included in the distribution costs of the current year. The provision for warranty was estimated at 650. So if you check the trial balance, there is a provision for warranty 580. Provision for warranty is 580. So we need to find out the warranty expense. Warranty expense. And so the payment of warranty which is 470, was included in the distribution cost. This distribution cost has this 5,200 as 470, which is payment. So distribution expense will take without the payment. And let's prepare a separate ledger account. Working number 3. Let's prepare provision for warranty account. Provision for warranty. So let's draw a T account. Provision for warranty account. And this has an opening credit balance of 580. Opening balance is 580. And the closing balance is given in the additional information 650. And the cash paid amount was in distribution opening balance. So out of 5,200, paid amount is 470. So that has to be deducted and taken to the provision account 470. So this is the cash amount. Cash paid amount is 470. Cash paid is 470. That has to be taken out from the distribution expense, and we have to take only the provision. Provision. How much is the warranty provision? The difference in this account. Profit and loss. Yes. Can you all tell me how much is the warranty provision? Sanoha, Havindu, Nilesh. Please tell me the warranty provision. Rama. take the total debit side, 1120, and 1120 minus 580 is 546. So 540 is the warranty provision. 540 is the warranty provision. That is the expense. And current liability, provision for warranty 650. Closing balance goes to current liability. Right. If you want, you can take all these payables as other payables as a note. So we did 3 adjustments: director fee administration, audit fee payable, court case claim for provision, and warranty provision. Warranty provision, we don't take on the administration because warranty is given for sales. We give warranty for sales, so it is a distribution expense. Warranty provision is a distribution expense, not a administration expense. Okay, so remember that warranty provision is a distribution expense. Total warranty paid means warranty paid for last year. They have made a provision of 580, actually paid 470. And this year provision only 650. It's an assumption. Actual amount will be paid next year. This is why 470 was taken here, and there is a liability also. Liability is for this year. 470 paid for last year actual warranty claims. Is it clear, Rama? Right. Now let's move on to a very important adjustment, lease. Working number 4. The company entered into a lease agreement on 1st of April 2018. So that is beginning of the year. Obtained the right of use of motor vehicle for a period of 5 years. The cost of right to use the motor vehicle and its useful life were estimated 5,960 and 5 years respectively. They have leased motor vehicles. Cost is 5,960. Lease term is 5 years. Useful life also 5 years. Lease term is 5 years. Useful life is also 5 years. According to the lease agreement, 2,500 was paid as the down payment. Down payment is 2,500. installment is 1,250. This is the annual installment. According to the lease agreement, 2,500 was paid as the down payment on 1st of April. First annual installment is 1,250. So annual installment means every year they have to pay 1,250. 1,250 into 5. That's the annual installment. Okay. Initial measurement of the lease liability was 3,460 because from 5,960, if you pay 2,500, the answer is 3,460. That is okay. Interest, lease interest. Interest, year 1 is 346. Interest, year 2 is 256. So you don't need to prepare the lease, the schedule. Lease installment schedule you don't have to prepare because they have calculated and given the interest for next 2 years, this year and next year. Then they are telling that only the down payment and the first installment paid by the company have been recorded in the lease payment account. So if you check the trial balance, there is a lease payment of 3,750. 3,750 means the down payment and annual installment, the total. That amount is debited to the lease payment account. Right? So let me show this in ledger accounts. Then you will get a better understanding. So I'll draw an account write-off use assets. This is the motor vehicle account. Right? Write-off use asset book. This is the motor vehicle account. And you can draw lease liabilities. Lease liabilities account. Lease liabilities. So I'll tell you the steps. Steps for lease. First step is record the fair value of the asset. Fair value means the cost. Fair value. Double entry is write-off use the asset account debit. Lease liability account credit. 5960. When we purchase an asset, right, on lease, the first entry is asset account debit, payable account, lease liability account credit. Asset account debit, liability account credit. Then what happens? We make the down payment. Number 2. Down payment double entry is cash account credit, lease liability account debit. Cash. Right? 2,500. Then the third one is current year interest. Lease interest. Third one is interest. That will be credited. That is also payable. Once it is incurred, we have to pay. First year interest is 346. Credit the lease liability account and debit the interest expense account. That is other finance expense. Lease interest. Lease interest is 346 for the first year. Here we took lease interest 346. Here credit 346. And the fourth step is annual installment. It is cash account credit, lease liability account debit. It's also cash. 1,250. Right? So this total cash payment, 3,750, which was given in the trial balance 3,750. So that is, we have to credit from here, and that is what we debited lease liability account. This total 3,750. Right? So first step, record the cost, then record the down payment, then the current year lease interest, then take it under expenses, then the annual installment, cash account credit, lease liabilities, debit. After that, you have to take the closing balance carried out. How much is the balance brought forward? Balance carried out. What is the balance? What is the lease creditors lease liability account balance? Mariam, can you tell me how much is the lease liability account balance? Good, very good. Very good. So, credit balance total 6306 minus 2,556. That's the lease liability account balance. 2,556. Two five five six. Okay. Now this is next year. Oh, this is the total liability. We can't record this total liability as a non-current because there is a payment for next year. Right? So we divide this current liability and non-current. We divide this 2,556 as current and non-current. Can you all give a try? What is the current liability and what is the non-current liability out of this 2,556? Annual installment is 1,250. How much is the current liability? How much is the non-current liability? So next year we will pay total amount of 1,250. Next year our annual installment is 1,250. Right? Out of that, there is an interest. Interest for second year. Interest for second year is 256. That's a minus. Therefore, next year capital repayment. Capital repayment for year 2. Capital repayment for year 2 is 1,250 minus 256, which is 994 is the next capital repayment for next year. Capital repayment for next year is 994. We pay annual installment 1,250. Out of that, there is the interest of 256 for next year. So capital repayment is 994. Then that is the current liability. Non-current liability means out of balance brought forward. There is a balance brought forward of 2,556. If the current liability is 994, the remaining is non-current liability. First you find current liability, then the remaining balance you take it as non-current liability. So this is current and non-current. Right, so in your statement of financial position, your statement of financial position, non-current liabilities, non-current. Non-current is 1,562. 1,562. And current liability is 994. 994 current liabilities. So it's not over yet. We need to calculate the depreciation. Depreciation is step number 5. It's a separate step. Step number 5, annual depreciation. Depreciation equal cost divided by useful life. Cost is 960 divide by 5 years. 960 divided by 5 is equals to 1,192. 1,192. Depreciation. So we can directly credit that to the right of use the asset as depreciation, and net value can be transferred to the statement of financial position. 1,190. This is profit and loss. So 5,960 minus depreciation is the net value of right of use asset. Depreciation has to be taken to the profit and loss account. Depreciation is a distribution expense. 1,190. complete this adjustment. I'll give 2 minutes. Just go through and complete. But if you take 2020, 18 papers also, they have checked the similar, like understand the method or the technique, and it will be easy. Follow the steps. Follow the steps. Right. Any questions? Is it clear? Nigesha, Shima? Shant, are you okay? Good. Uh, yes, that is correct. Asset now. The tax brought forward is 4,768. You have to take it under non-current asset. Right of use assets. Right. Use assets. That has to be taken under non-current asset. We don't take it to the PPE. Better to show that separately in your statement of financial position. 4,768. Right of use the asset. So that completes the lease adjustment. Lease interest and motor vehicle depreciation comes for the expenses. These two are expenses, right? And liability, we have to divide current and non-current. The net figure of the lease asset goes to non-current asset in statement of financial position. Let's move on to the next adjustment, which is next adjustment is depreciation. Working number 5. Adjustment for PPE. So PPE adjustment, it says The composition of property, plant and equipment and their accumulated depreciation are as follows. They have given year-end balance, opening balance for accumulated depreciation, right? So we can take that here under accumulated depreciation, 11,000 for building, 4,000 for office equipment, no balance for the land. Okay. So now there are two new purchases. The depreciation for the current year has not been provided. So we have to calculate the current year depreciation. The motor vehicle obtained on lease basis is used for distribution activities. That is why we took normally motor vehicle, you even though if they tell or not, take it under distribution expense. Building and office equipment are used for administration. Office equipment depreciated on straight line method at 25%. Assume that the residual value of the motor vehicle is 0. Property, plant and equipment acquired during the year. 1st of July, land at cost of 10 million. 1st of October, equipment at cost of 5 million. These items have been correctly accounted. Right. Then there is a building revaluation. So I will keep the building and let me do other assets, the two assets. Land, there is a purchase. Purchases. There is a purchase of land, 10,000. Purchase of office equipment, 5,000. And they have given the closing balance. Land is 30,000. Office equipment is 15,000. Because these two already adjusted. Acquisition already recorded. Then what is the land opening balance? Opening balance of land is 20,000. Office equipment balance is 10,000. Then we need to calculate depreciation. Depreciation. So let's calculate depreciation. Office equipment. Now, there are two office equipments. old 10,000. And there is a new office equipment of 5,000. So office equipment depreciated 25%. For 12 months. And this is 25% for how many months? 1st of July. July, August, September, October, November, December, January, February, March, 9 months. $10,000, 25%. $937.5. Give me a minute. Sorry, office equipment purchased on 1st of October. Land was purchased on, there's a small mistake. Land only purchased on 1st of July. Office equipment was purchased on 1st of October. 1st of October means only 6 months. 6 months. 5,000 into 25% into 6 over 12. Total 3,125. It's the depreciation for office and take it under vendors. 3,125. $3,125. Right. So that is all we have for depreciation. We can take the book value. Land no depreciation. So book value is same as the cost. Now another very important part, revaluation. This is also an area where a lot of students make mistakes. Revaluation. So then what happened is the building was revalued for the second time on 1st of April 2018 for 38 million. The first time revaluation of the building on 31st March 2014 had resulted in a deficit of 1,500. The remaining useful life of the building after the second time revaluation has been estimated as 8 years. Assume that the residual value of the building is zero. No accounting entries have been made with respect to the second time revaluation. So the amount in here trial balance 45,000, that is the opening balance, right? 45,000 is the opening balance, but other two, the purchase is included. Therefore, we take it here. Building. Opening balance 45. Opening provision for depreciation 11,000. Now the building was revalued for 38. Right? Can you all tell me what is the building revaluation profit or loss? How much is the revaluation profit or loss? How do you calculate revaluation profit or loss? Now the cost or the revalued amount 45,000. Then accumulated depreciation. Stuff April 2018. Already depreciated 11,000. Book value 1st of April 2008. 34,000. That's the book value. Now 34,000 worth of building we are revaluing for 38,000. So there is a revaluation. How much is the revaluation profit? Revaluation profit is how much? 4,000. That's the revaluation profit. So what you do is this 11,000 first, it will be transferred to the cost account. Transfer to right. Transfer of on the building account you have to do that. 11,000. And this is actually against the additions. We increase 4,000. You can separately say that. It's fine. Revaluation profit 4,000. So if you revalue, after the revaluation, new cost will be 38,000. So you should get the answer as 38,000. That's the balance carried down cost. 38,000. Then we can depreciate the building. Current cost is 38,000. Divide by 4,000. But there is a doubt, why did you deduct the depreciation of building? Because now when there is a revaluation, you cannot have a accumulated depreciation. So everything will be transferred to the building account. Now the accumulated depreciation is zero after the revaluation. After that, you have to depreciate for the revalued amount for 38,000. Here, that is why we have calculated 38,000, and the remaining useful life is 8 years. The remaining useful life of the building after the second revaluation has been estimated as 8 years. So now current year depreciation is only 4,750. So that is our building depreciation. Four seven. And calculate to the time. Is it clear, Udesha? And there is one more part. We calculated the depreciation and revaluation profit was added here, and this has to be credited. Now, revaluation and profit double entry. Building account debit. It has to be credited. Normally, it will be credited to revaluation reserve account. So if you check the trial balance, let me take all the balances. Stated capital 45,500, retained earnings 6,395. revaluation reserve, there is nothing, 0. Okay. Now, in the additional information, they have said according to the first revaluation, there is a deficit of 1,500. So in the previous revaluation, the deficit, if a deficit come at the initial revaluation, that will be taken to the income statement, profit and loss account, right? So in the second or subsequent revaluation, if we have a profit, the profit we can't take to the revaluation reserve account. What you have to do is you have to set off with the previous loss. So in the previous year, we have taken 1,500 into the profit and loss account. Since this year, there is a profit. That profit and loss 1,500 should be set off. So we have to credit profit and loss account 1,500, which is the previous year loss, and remaining balance only we can credit the revaluation reserve account. $2,500. Double it. Right. So we credit building revaluation, profit, revaluation reserve account only 2,500. And reversal of building revaluation works it off. The expense minus 1,500. Right. The surplus we can take under other comprehensive income. Building revaluation. $2,500 take to profit and loss. 2,500 you have to take to the other comprehensive income. Then complete the PPE statement. find the closing balance. $71, $125. That's the PPE balance. Complete up to this point. I'll give 2 minutes. Ask the questions if you all have any. Any questions? Is it clear? Asmir, Harindu, Rama. Right. So now let's move to the next adjustment. Income tax. What do you have for income tax? Provision for income tax is 725. Income tax is 1950. Paid. Right. And additional information is income tax paid during the year includes 600,000 paid with respect to previous year. So previous year actual amount is 600. Income tax for the current year estimated as 1920. Right. So let me explain this income tax. So many students had doubts on income tax, right? I will explain again, okay? So if you didn't understand uh, the previous session, let me explain this part again in a different method, right? So we can use two accounts, two ledger accounts for the income tax. That is provision for income tax account, provision for taxation account, and taxation expenses. Two ledger accounts. Right. Then I'll give you the steps. Steps to do. First step, before the opening provision. Opening provision was given in the trial balance. Provision for income tax, 1st April 2018, 725. Opening provision. Then we'll do the second step as under over provision. We have made a liability of 725, but actually paid is 600. Right? That means 725 provided, actually 600. We made a liability of 725, but actual is 600. And this is a over provision. Over provision of 125. Last year, we made a liability of 725, but actual amount is 600. So there is 125 extra. What you can do is deduct from the liability and credit the expense. Deduct from the expense. Over provision. Now, liability will be reduced. Out of 725, you deduct 125. So only 600 is the last year actual liability. Then the third step, record the current year estimated. Current year estimated. How much is currently estimated tax? 31st March 2009, estimated 1,920. 1,920. So double entry will be payable account credit, estimated 1,920. Liability account, provision account credit, expense account debit 1,920. So here what we have done is from the expense 125 all over provision. 125 already provided in the previous year. Therefore, that was deducted from the current year expense. Okay. Then fourth step is tax paid. Tax paid amount is income tax paid 1,950. So that will be debited the provision account. That's so I'll write the steps. Step number 1 is opening balance. Step number 2 is over provision. 3 is current year tax. 4 is tax paid. So you can use this calculation. Difference in this account is closing balance. The provision for tax. Difference in this account is transferred to profit and loss account as the expense. So these are the two amounts that we need. Profit and loss 1,795. Yeah. Income tax 1,795. And the liability 570. Tax payable. Is it clear? Sanoha? Rahma? Shima? Always you can follow this step. If anyone didn't understand, please tell me. I have another method also. This method is okay, we can proceed with this. Or if you didn't understand, tell me. I have another method to explain this without using ledger notes. All good? Okay. So I'm not going to explain that method. We'll proceed with this in all the future questions. Interim dividend paid amounting to 1.5 million has been included in the distribution cost. Directors proposed dividend 1 million. Interim dividend 1,500. So that is in the distribution cost. So in distribution, we have to deduct interim dividend minus 1,500 from the distribution, and it has to be taken to the change as in equity after net profit minus interim dividend minus 1,500. That has to be recorded under retained earnings minus 1,000. They have mistakenly taken to distribution. So remove from distribution and take it under retained earnings. And proposed dividend, we don't record. It will be shown as a note. Right? So I'll do that at last. So that completes all the additional information. So already now they have given 40 marks. If you have done all these adjustments, around 30 to 35 marks you have taken. Almost 30 to 35 marks given for all these adjustments. Right? Now PPE we took, accumulated depreciation also we took. In the other balances, let's record in the relevant places. Sales 88,000. Cost of sales 45,000. Inventory 4,200. 4,200. Trade receivable 17,300. There's no provision for doubtful debt. Trade payables 19,000. Cash and cash equivalent 750. All these finance expense 7. Open. Other expense 1,000. Take these balances. Admin, distribution, finance. $21, 620. It's a question. Director's fee from opening balance 4,500. We deducted 900. Again, I didn't deduct. I added. This total is 4,500. 3,600 plus 900 is 4,500. I separated. I didn't deduct. I separated. Director's fee. This total administration expense 4,500. Accumulated accumulated depreciation we transfer to the building account because when there is a revaluation, you cannot have accumulated depreciation. We have to set off that. That is why accumulated depreciation account balance was taken to building account to get the net book value. After that, we consider that as a brand new building, brand new value. So for that only, we depreciate for the remaining useful life. So there we cannot have an accumulated depreciation balance when you revalue. Other than that, we have to show some notes. After the statement of financial position, you can write a heading note. Note number 1. We normally take note number 1 to the profit before tax. So say that profit before tax has been calculated after charging the following expenses. So you can write few important expenses: director fee, audit fee, provision for warranty, provision for claim, lease interest, registration. You can take these plans. And for this, you will get 4 marks, 2 marks, not bad. Income tax also, if you want, you can have a note. It is here, note number 2. Note number 2. You can give PP also, note number 3. It's also you can write to use. Another very important note. About the interim dividend, the proposed dividend. Final dividend of 1 million has been proposed for ordinary shares that we have to mention as a separate note. That's it. Notes. In exam, these notes are important. This is other things you do working slow. Anyway, you will have to work. This anyway, you have to mention as a note because you get marks for this. You get marks to show profit before tax calculation and final dividend. Right, 1 mark for this, 2 marks for this. Right. Any questions? Is it clear? So I want you all to do all the other past paper questions, and in the next class I will be discussing cash flow statements and try to do 2018, 17, 16 papers. And if you all have doubts, if you want me to explain, we'll explain it within that before the next class. We have a separate session and I will explain. Okay.